Okay guys, welcome back. So this video is going to be all about this chart right here. You're looking at the three sister ETFs by Global X, which write at the money covered calls on three different indexes. But you're going to notice a trend here that the yellow line, QYLD, which happens to be the most popular by a long shot between these three, has underperformed quite significantly relative to the other two. In terms of price appreciation, over the past 1 year, XYLD is up 7.5%, ryld almost 4%, but QYLD is down 5.5%. As mentioned, they all operate in the exact same way, so I'm going to try and give my explanation and thesis on why I think XYLD is underperforming relative to its sister ETFs. And as always, if you guys enjoy my content, let me know, leave a like, subscribe to the channel, helps me out a lot with the YouTube algorithm. But let's get started. Okay, so the first thing I want to say is that for the vast majority of people, these ETFs are not good investments because they're too specialized. The standard advice here is to invest in a broad market ETF like VTI, dollar cost average over 40 years, and by the end of it, you should be able to retire. But for people like us that watch finance videos on YouTube in their free time, we usually have more dynamic portfolios and already have all of the exposure that we want to specific equities. And in these situations, this is where these ETFs can really shine because they can introduce a new level of income to your portfolio. And on top of that, they can even act as a great hedge in sideways moving markets. But getting back on topic, we're trying to figure out why in specific QYLD is underperforming. So initially when I was researching this video, I came across articles like this. QYLD, this popular 12% yielding fund, isn't performing as well as XYLD and RYLD. And I went through this article, and essentially what he does is he makes a model as if he bought 100 shares of each, and he shows that yes, QYLD has indeed underperformed. But to me, that really doesn't answer any of my questions. We know by looking at the price chart that it has lagged behind. The question is why? Because as investors, it's all about the future performance. If you're always trying to chase past performance, you're probably not going to be a good investor. So now let's get to my whole thought process on why I believe QYLD is underperforming. I want you guys to take note of the time frame because this all happens on a month-by-month basis. So on the first of the month, I have it laid out right here, they buy all of the stocks in the NASDAQ 100. Also on the first of the month, they sell at the money calls on those stocks. And then at the end of the month, the calls are settled in cash because these are index call options. And it's important to note that these call options cannot be exercised in advance. It has to be the end of the month. And coming back to the chart, we can see that in a more visual format. Now, a key concept you have to understand about these ETFs is that you're not investing in the actual equities, in this case of the NASDAQ 100. Now, the best way that I've personally found to understand options in the stock market is the insurance company analogy. Because when you sell options, you're essentially providing insurance on stocks. That's a great way to think about this whole situation. And there's two types of insurance, there's put options and call options. Of course, in this situation, we're dealing exclusively with call options. And the type of insurance that call options offer is that it allows you, the buyer of the call option, to buy an asset at a predetermined price. And I call this FOMO protection, or protection from the fear of missing out in case the price of a stock goes to the moon. You have the right to buy it at that predetermined price. So getting back to QYLD, in this example right here, I have the QQQ beginning the month at a price of $100 and ending at a price of $105. In this situation, the buyer of the call option executes their right to buy these assets at the predetermined price of $100. And as mentioned before, because these are index options, you don't actually transfer the shares, you just settle the difference in cash. And this explains why you have absolutely zero price appreciation when it comes to at-the-money call options, which these ETFs utilize. The only return you generate in this whole time period is in the very beginning of the month when you sold those call options and you collected that option premium. So again, when it comes to these ETFs, don't think of it as investing in the actual equities, think of them as a side business selling insurance on stocks to generate income inside of your portfolio. And another key concept here is that the amount of income generated by doing this is directly tied to the amount of volatility in the underlying index. And here is where QYLD shines because the NASDAQ 100, it's tech heavy and it's very volatile, and thus it generates over a 12% dividend yield at the current moment. And for comparison, XYLD is the same exact mechanics, but on the S&P 500 index, which historically is a little bit less volatile than the NASDAQ 100. And that's why the income generated here is a little bit less at 8.72%. But in my opinion, this right here is the key to understanding why QYLD is underperforming its other ETFs. So additional volatility is great, it gives you a higher level of income, but excessive volatility, especially to the downside, can take a very long time to recover from. So I have one more example right here. It's identical to my first example. The key difference here is that the price goes from $100 down to $95. So in this scenario, the call options are not executed by the buyer. And the net effect of that is that QYLD drops in value along with its index. But tying this back into the volatility and why QYLD is underperforming, you can see here that when the market goes down, QYLD goes down along with the market. But when it goes up, you do not participate in any of that price appreciation. All of your return is generated by the option income. And as we saw, the yield right now on QYLD is roughly 12%. So if you divide that by 12 months, you have a return of about 1% per month. So in a situation that the NASDAQ 100 goes down 10%, it could take you 10 months to fully recover from that, and that's only if every subsequent month is positive with no additional price losses. So that's my thesis on why I believe QYLD is underperforming its sister ETFs. Ever since November of 2021, the NASDAQ 100 has been extremely volatile, just moving sideways. That's both good and bad for QYLD because it helps it to generate a very high yield, but it can take a long time to recover from these downturns, and if they happen too frequently, you never recover. But that's just my take on the whole situation. Let me know your thoughts and opinions in the comments down below. If you're still watching and enjoyed, give the video a like, subscribe to the channel, helps me out a lot and it's greatly appreciated. But regardless, I'll see you guys in the next one.